with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. China has recently announced a series of measures to support the economy. The measures include cutting the bank's reserve requirement ratio, lowering mortgage rates on existing home loans, and introducing new tools to boost the stock market. Our Huang Yue has the details.
People's Bank of China Governor Pan Gongsheng announced that the central bank will soon reduce the amount of cash that banks must hold as reserves, which is known as the reserve requirement ratio, by 0.5 percentage points, thereby freeing up liquidity of about 1 trillion yuan, or about $140 billion into the market for lending. The governor added that China will also lower mortgage rates on existing home loans to a level similar to those of newly issued housing loans, and the average reduction is expected to be around 0.5 percentage points. He also said the down payment requirements for buyers of second homes will be reduced from 20% to 15% nationwide.
The reduction in existing mortgage interest rates is expected to benefit 50 million households or 150 million people, reducing household interest expenses by an average about 150 billion yuan per year, which will effectively boost consumption and investment.
New tools to boost the capital market were also introduced. The central bank will establish a swap program for securities, funds, and insurance companies to have easier access to funding to buy stocks. It will also create a special re-lending facility to guide commercial banks to provide loans to listed companies and their major shareholders for buybacks and increasing shareholdings.
To enhance the stable operation and development capabilities of large commercial banks and strengthen their role in serving the real economy, the government plans to increase the core Tier 1 capital for China's 6 large commercial banks in a gradual manner.
The official said the rate adjustment will have a neutral impact on China's commercial banks. Although lowering existing mortgage rates will reduce the interest income of banks, it will also decrease the number of customers repaying their loans in advance. And the central bank's reserve requirement ratio cut will provide banks with low-cost, long-term operating funds.
And that's Huang Yue reporting. So how will all the supportive policies affect the real estate market and the individual home buyers? Can they address many of the market concerns? And what does it mean for China's economy? For more on this, join us on the line now are Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, Chen Jiahe, Chief Investment Officer at Novel Market Technologies, and also Yan Liang, Professor of Economics, Willamette University. So, Professor Qu, I will start with you. China announced a slew of policies to boost the economy, including cutting the bank's reserve requirement ratio, lowering mortgage rates on existing home loans, and also introducing new tools to boost the stock market. So, tell us, why is it now, and what are the key measures that impress you most?
Well, I think the current background, everybody have already seen that in China, we've been facing a gear shifting period of time. And when China tried to restructure its economy, facing a new period of time. So we need the boost from the financial and also fiscal policies to help China to boost up the financial market as well as the housing market, so that the whole expectations for economic growth can be revised. So I think against that background and in domestic circumstances, meanwhile, internationally, we'll be seeing that major economies over the world are facing slower growth, and also they try to lower the interest rate. And all this uncertainty combined together, plus the geopolitical conflicts, I think within China, the central bank and other financial authorities together released all kinds of policy combos, try to help to boost up the economy. Right now, China has been facing a turning point of how we can, revive the whole financial market, and also using the financial market as an important tool to boost the real economy. And I think currently, the slew of the policies actually has been caught as a bazooka of lots of the policies. I think there are they can be broken down into two parts. Number one is try to reduce the burden of the home buyers and to help the normal families to repair their balance sheet so they can spare more of their incomes to spend in their daily life as well as for the further investment. For example, we just lowered the mortgage interest rate by 50 basis points, and by that, probably in the coming years, they will save lots of the money for the family. Just say if you borrow like 1 million Chinese yuan, so basically you're going to save like 900 yuan per every month. Say you borrowed from the commercial bank for like 30 years, so 900 yuan will actually be a very substantial help for the families, for them to buy the groceries and everything. So I think this is very important. And also, I think they lowered the threshold for home buyers, actually the no home buyers. Recently many people try to improve their living conditions because they have the second child, or they try to bring in their parents to live with them, so they need a larger house. Previously, we have luxury house tax more than the ordinary house, and also the down payment for the second home is much higher, like 40% or even 50%. In this regard, they lowered the threshold for the down payment lower to like 15%. That is, I think, probably the lowest level, even for America, for European Union. So I think that is the best offer they can provide for the home buyers, the new home buyers, and also to encourage them to buy a larger home for their family. And I think second part of the policy, which impressed me, is that they really have a very aggressive move, try to bring in the liquidity into the financial market. For example, they have been lowered the triple R by 50 base point, which will release about 1 trillion yuan into the market. And more than that, I think the central bank has set up a SPV to help the listed company, to help the non-banking financial corporations like the insurance company or the security companies, to help them to buy into the stock market. They set it up like a 500 billion yuan worth of the SPV for the security companies, insurance companies, and also another 500 billion yuan for listed company. And this is actually a targeted measure towards the stock market. Well, this I think is the first time in the history of this country. It's more like a targeted QE. Well, I know it's not very precise, but you can understand it in that way, to actually help the listed companies to improve their condition, balance sheet, employment, and also to help them to manage their capitalization. So I think all in all, this combo or this bazooka of the policies can help the economy. If you take a look at the current, financial market, stock market, for sure, the feedback is very positive.
And now let's talk about it one by one. And Yan, the central bank will cut the reserve requirement ratio by 50 basis points, and that would free up about 1 trillion yuan for new lending. So how will this measure help to boost the economy? And which sectors or areas can this money go?
So I think, first of all, I don't think this RR cut is as unprecedented or unusual as others. I think the reason that these new stimulus package has been really sort of, called like bazooka or mini bazooka was because it's a whole package thing. So just because the RR cuts, I think, we know that, for example, last year, 2023, there have been two RR cuts, 25 basis points each. And this year, earlier in February, we also had RR cuts. So in a way, I think this is definitely welcomed because it does, provide more liquidity to the market, and that could definitely help with, businesses that need to take loans out, for industrial production, for some of the the unsold housing purchases and consumer loans, what have you. So it will help the banks to be more willing and be less costly for them to lend. And so I think that would be helpful for the economy. But I think, there are other measures that are, to me, more important, like, for example, the rate cut of the 7-day reverse repo that has been cut by 20 basis points to 1.5%. So again, that would help to economize some of the lending cost and borrowing cost for the economy. And the mortgage rate reduction, I think I agree with Professor Chi Qiang. I think that is very helpful because this is not something that will be, reversed or anything, and directly help households The estimate is that it's going to help to reduce the mortgage payments by 150 billion yuan for 50 million households. And there's also lower the down payments and all of these. I think that really helped the household's bottom line, because I think a lot of people argue this is a bazooka, this is just monetary easing, and not helping the demand side, and it's only helping the supply side. I think they lose sight of how much boost this is to the consumers, to the households, to help them, to save more cash for discretionary spending, to help to boost, the real estate, or at least to stabilize the housing market, and also to bolster, the consumer confidence. So I think, this is not the traditional sort of monetary easing. I think, like Professor Chi said, it's targeted, and I think it works both for the supply side, but also for the demand side.
So Jiahe, so the property market support package actually include a lot. So what does it mean for the housing market and also for the individual home buyers?
Well, we have seen quite many policies given to the property market. Basically, the down payment ratio for the second home has been dropped from 25% to 15%. And there has been a cutting of mortgage interest rate for the remaining mortgages that will lower the financial burden of those people who are dewing a lot of money to the bank, so they're paying much less each month. So this actually means that these people would be able to consume more, as Yan just said, because they have got more cash flow every month. They don't have to pay that much to the bank. And if you look at the stimulation to the property market, the down payment cutting for the second home will mean that the people who want to buy their second home would be able to do that with a easier affordability. Basically, because when you compare people who are buying their first home and the second home, there's a huge difference. Is that the people who are buying their first home, they might have some urgent needs. For example, they want to live in their own flat. They want to have a school quota for their children, all these kind of things. So it's usually for people who are buying the first home, they're considering a bit less about the financial burden or the amount of down payment, stuff like that, compared with the people who are purchasing the second home. Because when people are purchasing the second home, this means they have already got somewhere to stay, and they have got somewhere that's kind of a primary school that their children can go to, whatever. So their urgent need has actually been filled. And the reason they want a second home is because they want to invest in it and they want to get more money out of this. So that means they are more looking at the financial return rather than the urgent basic needs that they are getting from the properties. So this means if you cut the down payment from 25% to 15%, for these people, if they want to buy, it will be easier for them. And their financial gaining will be much larger compared with before, because they can use much less cash for the down payments, and they can actually put the cash somewhere else to invest if they have already got the money. For example, the stock market that is really very quickly recent days.
And Professor Chu Qiang, actually, the People's Bank of China will set up a swap facility allowing securities firms, funds, and insurance companies to tap liquidity from the central bank to buy stocks. So tell us, why is this move and what's the market response?
So I think basically the central bank has set up a SPV, a special purposed vehicle, to help the brokerages or other non-banking players to tap into this market. Basically, they can use their own valuable securities as a collateral to borrow money from the central bank. And central bank will give them the T-bond in return, so they can sell the T-bond in the secondary market for the cash. So they can tap into this stock market to buy more to support these market value, and it serves more like a stabilization fund. So the whole bottom line or floor level of the whole stock market now have more of the insurance to be guaranteed. So I think this is how it worked, and but I think this is different from what is the actual QE or typical QE towards the stock market, like what American Federal Reserve has done back in the 2008, is because in the 2008 for the Federal Reserve or for the Japanese central bank, the BOJ, the balance sheet or the liquidity actually goes directly through the central bank. So which means the balance sheet of the central bank will take over all the turbulence of the value changes in the stock market. And for China's SPV or this planning, I think the brokerages, security company or the insurance companies, they will use their own balance sheet to take over the turbulence in the stock market, but only they have the central bank to got their back. So I think this is direct and indirect differences will have some a little bit different responding. So we'll be seeing that in China. First of all, of course, this is going to be definitely a very good news for the stock market. So I think in 2 days or in 3 days already, I think the market feeded back very, very well. But also, I think there are still some people are hesitating because we can see that because the brokerages, they're using their own balance sheet to support the stock market. So it's not the central bank itself. So I think that's the reason why I think the investors, especially the individual investors, will hesitate to be getting involved very deep. They probably will have a limited participation and try to play safe.
So, Jiahe, you are an experienced investors in the market. So, how do you look at this swap facility?
Well, when we look at this, it's definitely a strong support for the stock market, because it injects a lot of liquidity into the market. And so it looks like the stock market is responding really well because this policy has been given a very direct support to the stock market, showing well, this is not only talking about the money when we say, okay, there is a large chunk of money going into the stock market. There is also about the determination of the government. The policy direction of the government is telling you that here is the bottom. We think here is the bottom. We don't want the stock market to keep on falling. So we're putting all this money into the market. Are you following us or not? So this is a very clear sign that is given by the government and the authorities. And this has been picked up by the stock investors. So, yeah, I mean, it looks like the stock market is really well in the recent trading days.
So what do you think about this swap facility? And also the central bank governor Pan Gongsheng said China is weighing plans for a stock stabilization fund. Is that an international practice, or do other countries have this kind of experiences?
So I think this time around, it's just make it a lot more open that there has been 2 swaps. One is $500 billion worth of swap for funds, insurers, and also brokerage firms to buy stocks, and another swap of $300 billion worth for banks to lend to companies to do stock buybacks and so on. So it's just making very clear that there's no more guessing game, that yes, the government will help to provide policy support to stabilize the stock market. So I say this is nothing really unprecedented, and it's also not unique to China in the sense that, like what Professor Chu mentioned earlier, the whole QE, right, was really a signature policy for the United States government to help to stabilize their financial markets, housing markets, security markets, bonds market, stock markets, and so on. So I think this is a relatively, I would say, usual practice, not just in China, but other countries, to take direct measures to help bolster the market when, it's not doing well. Now, I think for China, we also know that the stock market has been underperformed. I think this has been quite a consensus that there is the sentimental issues that, China's stocks are undervalued, given their earning potentials, given, their strong real economic performance. So I think, this action is quite well justified, so that I think this will help to foster a more virtuous cycle. And I also wanted to say that, these kinds of policy measures, especially how they're communicated, is very important. So I think, the Western media and many of the, analysts were quite surprised that, this press conference has been, live, and it has been open and taking questions from the audience and so on and so forth. So I think this really shows how PBOC now really, emphasize the way that monetary policy is being communicated to the rest of the economy. And I think this is very important because this really helps to, shape the market expectations. The former Fed chair, Ben Bernanke, when he stepped down, he said something along the line of, for monetary policy to be effective, 98% is about the talking and 2% is really about the real action. So I think to be able to communicate this idea that the government is taking active measures to help to stabilize the markets, I think that is really helpful in and of itself to strengthen the confidence and help to put in that market momentum going forward.
And a lot of supportive policy. So, Professor Xu Qiang, how would you characterize China's overall economic performance right now? And with such a slew of policy supports, so what do you think is the outlook for China's economic recovery for the rest of the year?
Well, I think Chinese economy right now is in a stabilization phase. For the real economy, we'll be seeing the export are maintained a very good momentum. This trade surplus has been there definitely. And also, we'll be seeing the manufacturing and high-tech industry for China is been growing, especially for the smart manufacturing has been growing with double-digit growth. And also be seeing that the housing market has been stabilizing. But I think the problem we have here is that the financial market or the whole market sentiment is not at the very stable situation. For example, for the stock market in the first half of the year, we've been seeing has been tumbling around a rather low point, as well as for the housing market. So I think the sentiment is actually been affecting people's expectation. I have no doubt that Chinese economy will still maintain 5% of the GDP growth target for sure, but we still need a good expectation to boost the whole economy to grow higher and better, and also eventually benefiting to the normal people. So I think out of these reason, I think currently Central Bank of China as well as the Ministry of Finance can work together to implement more of the policies and to raise up the people's expectation. You see, when Central Bank of China just issued all this financial bazooka, and international investment banks and international funds actually, I think probably just a 180-degree turnover to start to sing the song about China. They've been saying now is the time to all in China's financial market. This is actually can help China to boost the foreign investment, to boost more of the future companies to grow out of the financial market support. And I think we will welcome more of the policy to come from not only the financial authority, but also for the fiscal authority as well as for the development-oriented authorities.
So as Xu Qiang mentioned, more policies to boost the economy. So how do you look at China's job market? And China will implement an employment-first strategy. So how will that help?
Right. So employment first strategy was released by I believe the State Council, and it includes 24-point guidelines. And so this idea is that employment is the most basic livelihood, and it's really related to vital interests of people and also the sound development of the economy. So that is really the top of the policy agenda. So I agree. I think there are very unique population growth, and that also in terms of the economic transition that I think presents some difficulties for the young people. So I think this guideline comes at a very timely in a timely fashion, and it includes 7 aspects, including promoting coordination between the economic development and employment, and it's also tackling structural contradictions, improving the support system for the key groups, especially the youth group, and also improve the employment assistance program and system for people in need. So I think in addition, to this idea that we have more sort of young people entering the job market, we also are all also in a transition where we are trying to upgrade industries. We're trying to, reduce some of the labor-intensive, very low-value added manufacturing production. We're trying to automate our production system and digitize it to improve the productivity. So I think some of these labor-saving technologies could have an impact, at least at this moment, because again, we need to also retool our education system to provide more, skilled training and the right types of education, so that our, young graduates are able to, gain the skills that is necessary to fit into today's employment market. And finally, I think when it comes to policies, so these monetary and financial policies are definitely helpful and very welcomed and very timely. But I think we do need more, especially I think on the fiscal side. So I think all these policies are very important. And again, the whole approach is to be, holistic.
So, Jiahe, do you agree with Yan, and with such a slew of policy support, what do you think is the outlook for China's economy?
There are a lot of rooms for China's economy to grow. If you look at the long-term economic growth potential of China, you are pretty confident that this can be done. It's basically because China is currently working at about 13,000 USD per capita. So that's if you compare this level with countries like South Korea, Japan, United States, United Kingdom, Australia, France, you can see that this is a level that we still have a large potential to grow, at least by another 200% in the long term, or maybe 300 or 400%. So there are a lot of rooms for China's economy to grow. And if you come to live in China, you don't have to live here every day. You come here every 3 to 5 years, and you see the difference of the societies, and you see the difference of people's lives, how easy you are now with your life compared with many years ago. For example, I've been taking a lot of high-speed railroad recently, and compare that with like 15 years ago. It's a remarkable improvement. It's now really easy for you to travel. So the economy is really growing every single year. So if you look at this from the very long-term picture, you're pretty confident about China's economic growth.
Well, thank you very much. We are speaking with Chen Jiahe, Chief Investment Officer at Nova Market Technologies, Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and Yan Liang, Professor of Economics, Willamette University. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.